Good afternoon, everyone. House taxation meeting will be called to order. First item would be request for bill introductions. Do we have any requests? Representative Turner.
Thank you, Mr. Chairman. Yes, I have an RS number 1798 that I would like to submit, and this is for persons that qualify for the homestead refund. This will extend the window of time that they're able to get that refund.
Was that number again 1790?
Incorrect. RS 1798.
Thank you.
All right.
Committee, any questions or objections? Seeing none, the request is approved. Are there further requests for bill introductions? Seeing none, we will move on to our presentation for the day. We're going to be taking a look at the State General Fund profiles with several different scenarios, and we'd like to welcome to Tax Committee Head of Research, J.G. Scott.
Thank you, Mr. Chairman. I don't get to be in front of this committee very often, so you guys are going to have to put up with me for a while. And what I was asked to do is put together some concepts on what a profile would look like. When we talk about a profile, it's where we attempt to put everything that the Appropriations Committee is doing, along with what the Tax Committee is doing, looking what our starting point is, adding revenues, subtracting expenditures, and kind of coming up with what we think is going to happen. And I say that generally think that might kind of happen sort of in a way. The document you have, it starts off with the beginning balance. So if you look on the yellow sheet, we'll start off with 22 at a little over $2 billion. So that's what we ended 2021 with and moved into 2022. Our total revenue was about 7.9 billion. And then we had expenditures about 8.2. So our ending balance would have been $1.8 billion. So we started off with 2. We ended up with 1.8. So when we look down at the bottom, our receipts above or below expenditures was about $260 million. So we spent about $260 million more than we took in. And how do we do that? We do that by spending some of that beginning balance. And then we start to move forward into what we think is going to happen. And just want to let everybody know this is not a prediction of what we think is going to happen. This is more of a planning document. So when we're looking out into the future, like I said, we're really not sure what's going to happen in 24, let alone 25 or 26 or 27. So we go ahead and just use our existing trends for both revenue, and then on the expenditures, we just adjust a couple of items in those out years. So in 25, the only things that we'll normally be seeing are increases in human services caseloads and in school finance. So those are those adds in 25, 26, and 27. So like I said, this is more of a planning document. We really don't think that we're going to get exactly $10.2 billion in revenue in 27. But if things keep kind of going where they are in the way we're kind of looking at, we did slow things down from what has happened in 23 and in 24. Moving forward then into 2023, we have beginning balance, the same as our ending balance of 1.8 billion. And our consensus revenue estimates, we had estimated about $9.7 billion coming in. And then we have governor's revenue recommendations. She made a few adjustments. So we do want to show what those are that adjusts those consensus revenue. Transfers of 770 million, 500 million of that went into the budget stabilization fund. So if you look down here right below the ending balance, you'll see the budget stabilization fund going from 970 million into almost 1.5 billion dollars. And that's referred to frequently as a rainy day fund. So that would be on top of what we have for an ending balance. So that's not included. And then there's a couple of funds, one 220 million that she set aside for local governments to use for federal match, and then 50 million for state agencies to use for match for the infrastructure program from the federal government. And then sales tax adjustments. She moved up the food sales tax and implemented earlier. And those are the only adjustments in 23. There was reappropriations. So our approved budget, when you left 2022 session, was 9,169,000,000. But what happened in 22, we didn't spend all of the money that we had appropriated for 2021. And if there's language in the appropriation bill that says the money can reappropriate, what that means is that if it wasn't spent, it has that reappropriation language, it would automatically go forward into the next fiscal year without any legislative action. So this was larger than normal. It was 321 million, and most all of that was around the human services caseloads, and then some on education as well. We also, when we do those consensus revenue estimates, we estimate what we believe those human services services that are required by the Medicaid agreement and others. So we estimated those caseloads would go down about $200 million state general fund. And all of these numbers are state general fund only. There's additional federal funds and special revenue funds as well. So we had, and the major reason for that reduction was the federal government with the health emergency had increased the federal match rate for Medicaid. So it went up 6.2%. So if the federal match goes up 6.2%, the state drops 2.2 or 6.2%. So almost all of that is around those savings. And then school finance, there were fewer students enrolled than what we had originally projected. So we reduced those estimates by 65. The governor recommended some changes, and I won't go over all of these. But once you add up all of the revenue, we ended up with $10.7 billion available to be spent. And in the total at the bottom, we had expenditures of 9.2. So we had a almost $1.5 billion ending balance. And once again, we spent about 350 million. And a good portion, some of that reason was because of some one-time expenditures that happened in 23. So if we have the $1.5 billion and move that up into our beginning balance, governor's adjustments, she had a transfer that switched from a transfer to an expenditure. State general fund impact was zero, but it freed up $205 million in revenue and added $205 million in expenditures. So it looks like a large change on both, but that's not the case as far as the ending balance goes. We took out the reappropriations, that money that they moved from 21 into 20, or from 22 into 23. So they can only use that one time. So we backed that out. We added the human services caseloads. Part of that 6.2% is going to be going away in 24. So a lot of this is backfilling that. And school finance, we added an additional $106 million in school finance, several other adjustments that the governor had made, one of which was Medicaid expansion. For this profile, the chair wanted to not include that Medicaid expansion going forward. So that is the one line that was taken out. The other line, I should have mentioned this earlier, is Integra. We do have Apex with suppliers that's been approved. It's waiting CHIP funding from the federal government, but we did include these expenditures to implement that. So those are the two changes from what the governor's budget would have looked like without this. And then do we want to stop there and ask questions and then look at estimates going forward?
Certainly, yes. And I had a question over here with Representative Helgerson.
JG, I love you, man, but you and I've been putting these together for 10 years or whatever. I'm looking around the committee and I see this glassy-eyed look. I get confused when you explain this stuff, and it might be better if you take it back a notch. Like first of all this is SGF dollars. It isn't. The only thing you're dealing with is state general fund dollars, and items such as when it's in parentheses, those are deductions or losses. And I don't know if everybody understands some of that stuff. And you might hit what's the key point from that you should take from each one of the years, such as when we go in the deficit or what the reductions are. If, I've tried to explain this a few times.
Yeah, Representative Sawyer.
I've got, okay, I like this first yellow sheet. So this sheet assumes basically the governor's recommend. We don't spend any more than the governor recommended. Whatever our final spending is, we don't spend more than her.
It is adjusted for the Integra and the Medicaid expansion.
Other than, okay. Yeah.
Yes.
And then there's no tax cuts in here other than what's already been done.
Just what the governor had recommended.
Right. Okay. And then going forward, your growth, what growth rate are you using?
And what I was going to talk about going forward, when it's bolded, those are estimates that KLRD has used.
Right. So what rate?
So we went through and looked at them individually for all of income tax, corporate, and I don't have that handy on what those actual increases were.
But it's based on what KLRD thinks.
Yeah, everything from 24 forward, which is why I kind of wanted to stop there, is estimates that KLRD has used, or we've gotten some input from others as well. But those are not those consensus numbers. Those are not approved actual adjustments. Those are just our estimates internally.
And of course, we're assuming there's still growth though throughout quarter 2027 in revenue.
Yeah,
we're not going to have a recession on this sheet.
This is not including a recession, which is what I was going to talk about is going forward. We're saying that things are going to grow, not as much as they were growing, but they will continue to grow.
Okay. So assuming all those assumptions, we don't really spend more than the governor other than Integra, which we think is going to happen, and we don't do Medicaid.
Right.
We don't do other tax cuts. Everything ends up pretty good all the way out to 2027. We still have a pretty solid ending balance, and we're not getting into the budget stabilization fund.
Right. I do want to mention one thing, that those consensus numbers, those do include current law. So the sales tax that we have approved is included in there. And in 25, 26, and 27, the local ad valorem, the city county revenue sharing, all of those are included in those rest estimates going forward. It's current law.
All right. Thank you.
Further questions for JG? Representative Francis.
So then the biggest reason we see the drop in the revenues, consensus revenue estimates from 24 to 25 probably reflects the sales tax and then the LAVTRF and the CCRSF or in the SCCHF. I like to use those little.
don't know what they mean, but I like them too.
Yeah, but that's why we see that drop.
Yes, exactly.
And then when you did the expenditures, did you, I think you told us, what percentage rate did you increase expenditures by each year after 24?
We estimated those lines separately for 23 and 24. What we have here is exactly what the governor recommended, except those two adjustments we had talked about. And then in the out years, we just estimated what we think caseloads are going to go up, 100 million in 25, 105 million in 26, increasing about 5 million a year. And then we looked at the school finance on what we think. And if anybody has a better idea, let me know what inflation is going to be, because school finance is now tied with inflation for 24, 25 forward. It's a 3-year average of the Midwest CPIU.
So you've got no increases in spending whatsoever, nothing for utilities, nothing for insurance, nothing for salaries in the out years at all.
No, the only thing that is included.
Caseloads and education.
Exactly. So do you want to mention that this is kind of stepping into the next line? What we do for expenditures is, if you look in 24, we have total expenditures of $9.5 billion. That is included then in our beginning balance, adjusted for some one-time expenditures that was in the base and additional ones. So in 25, you'll see the almost 9.8 billion, and that will be our expenditures for 26. 10 billion at the end of 26 would be our beginning for 27. And as far as adjustments go, negative means that we are adjusting expenditures. So when we look at the sales tax, we're looking at a reduction of $280 million for 24, and then moving forward on that. And the positive numbers and expenditures, that means that we're spending more money. And if it's a negative number, it means that it's reducing those totals.
And if I may, just to Representative Helgerson's point, I've been here for 7 years and these things still confuse me sometimes. It was my intent to get some of these scenarios in front of the tax committee because, I don't serve on appropriations. I'm not sure how many folks on this committee do, but I think it's important before we consider tax policy, especially a comprehensive package like we're considering, that we have some base knowledge on these. I mean, when I look at these sheets, there's 3 numbers that stand out to me that I immediately go to. That's the beginning balance at the top, the ending balance that's kind of bracketed or boxed in at the bottom, but then also the receipts above and below expenditures. That's key because that's our continuing. Are we continually spending more than we're taking in, or vice versa? So I think everybody probably has a different level of detail that they analyze these on, but I'm just trying to get a base knowledge and base understanding of where we're at looking into the future years. But if there's no further questions, Representative Abercamp.
Thank you, Mr. Chairman. The transfers for the CCRSF, LAVTRF, and the SCCHF. Can you briefly explain what those are and the amounts? I know the LAVTRF, but can you just go through them very briefly, what they mean, and then what amounts they are per year?
The LAVTRF, the local ad valorem tax reduction fund is distributed based on property tax. It's for property tax relief, and it's been capped at about, I believe, 54 million, and then it will go up in 25. But any of those that we just talked about have not been actually transferred since 2013. 2004. The city county revenue sharing fund is money that goes to cities and counties, and it's distributed mainly based on sales tax. And then the special county city highway fund is distributed based on miles of highways you have within cities. And then there's other funding that goes into the special city county revenue, or the special city county highway fund, because those also get some motor fuel tax and license and such. The total for 25 is about $170 million for the three. And then because that cap goes off, it goes up to about 250 million, a little less in 26 and a little bit more in 27.
So thank you, Mr. Chairman. So out of those three, though, the local ad valorem tax relief fund, that's the one that we don't normally do.
Right.
But the other two we normally do.
We don't add the additional state general fund to the city county highway fund. There's supposed to be a transfer for that, and there's supposed to be a transfer for the other as well. The constitutional required items go into the city county highway fund. So those are ones that get motor fuel tax and licenses and such. But the other two don't get any revenue pushed out into the local governments from those other two sources. And none of those, like I said, I think we transferred some in 2004, but the other, most of them, it was either 2003 or 2004 that haven't been sent forward.
All right, sorry. Thank you, Mr. Chairman. So I'm understanding in 25, 26, 27, we're looking at in 25, there's 170 million in this estimate that we haven't done in many years. And then in 26, there's $250 million cooked into this that we haven't done in many years. Is that correct?
That's correct. In that line, we'll talk more about that shortly.
Okay, please continue, JG.
Okay. So we continue this going forward. So won't explain all of it going forward. But when we look at 25, the sales tax, when we look at the transfer adjustments, you'll see a total of $374 million increase in transfers in revenue because of transfers. So 169 million of that is because we're not in this projection moving it forward. We're not making those transfers. So while it's included in that top line, then it's adjusted out below. So we have the 169 and the 9.9 million consensus number, 9.9 billion. But we then take it out in those transfer adjustments. The governor, in the budget proposal that she put forward, moved those dates out to 26, 27 for those transfers. So they're not going to be made for 25 according to the governor's budget. 26 and 27, we just projected those not being paid continuing on. So none of those transfers are in the bottom line when we go down.
Representative Francis.
So that had me come up with another question then. So there, the 170 for the LAVTRF and the others is in the consensus revenue estimates. It's taken out in the transfer adjustments. But what's the other 200 million that's taken out in the transfer adjustments?
Remember when we talked about that $200 million transfer for that was just shifted from revenue, reducing revenue to increasing expenditures?
No, I don't, but that's because of my senior
Okay,
status.
so So when we did 2023, we did a transfer adjustment, excuse me, in 2024, I'm sorry. We went from 770 negative to a positive 183. 205 of that million, 205 million of that amount was because we had been transferring money for the capital improvement money for school districts, bond and interest. We had been using that as a transfer out of revenue to a special revenue fund, so it just reduced the transfers. But statutorily, it's supposed to show as a demand transfer, and a demand transfer shows up as an expenditure. I know this is kind of getting down into the weeds, but since we're no longer doing the transfer, then we get $200 million more in revenue. So 184 of that 200, or 184 or 183 million is that 205 plus some other small reductions. And then that's the rest of that is that 205 million moving out into 25, 26, and 27.
Any further
Is everybody sufficiently confused?
further
Or do I
questions?
need to continue talking?
Go ahead, JG.
Okay. So then the process that we use here just goes on forward, and we make these same adjustments. The impact for the income tax moves forward. The sales tax, the food and feminine hygiene and diapers, I believe, moves forward in sales tax. We move forward with the Integra. And for this line, for the governor, we included in here the corporate reduction in 25 because the anticipation is that when it starts, it will have an impact of reducing the corporate income tax by 0.5%. And the projection is that that will show up in 2025 and move forward. So in 24, we have the Panasonic already included. And then in 25, we include the Integra. So the rest of those move forward as well. The one thing to talk a little bit about is there's $150 million in continuing expenditures for 25 for special ed and K-12. That includes special ed. The governor added $72 million every year for 5 years in her proposal. So that had $72 million included. Her proposal also put funding in for the high density at risk that is supposed to sunset after 24. So there was 76 million that was put in. So that is how we get to the 150. And then moving forward, we take back out the high density and leave the 72 million. So it'll show those adjustments going forward as well. Bottom line is we bring in and have available 12 billion and we spend 9.8, leaving 2.2, and we're bringing in an additional $310 million almost to the state above what we are spending. Moving forward, same thing that goes through for 26. We once again are spending less than we are bringing in. That ending balance goes up from 2.2 billion to 2.5, about 250 million increase. And then in 27, it goes up about 170 million to a total of $2.6 billion for ending balance. And it's increasing all of those years.
We don't have necessarily a balanced budget requirement, but we do have the 7.5% ending balance requirement.
Correct.
Using this scenario at at the end of, I'll jump all the way to the end at 27 at 2.6 billion. What does that represent? Where?
That would be,
What
if I was guessing, 25.4%.
Okay. Oh, yes, there it is down there. Thanks.
In between the two lines you look at.
Yeah, like I said, I focus on the ending balance, the above and
Okay, just to
So I
let you
did see
know,
that.
that's what I look at too. But yeah, I mean, this does project out a structurally balanced budget going forward. We're bringing in at least as much as we're spending. And truthfully, if we're within 100 to 200 million in 27, with all of the projections that are going on, I would say that's still really close. They could be up or down fairly easy. But this is trying to show kind of what you need to think about going forward.
Would you say the revenue projections in this scenario, are you fairly conservative? Are you fairly optimistic? Are we kind of status quo? I mean, where are we at on the revenue projections at the top
I
there?
mean, I would say that maybe cautiously optimistic.
Okay.
So we weren't continuing those trends that have been happening, but then we're not showing any type of a recession either.
Okay.
So we did slow growth down, but it's still continuing to grow.
Representative Sawyer.
And the other point I want to make on this sheet, like at 26 and 27, there is no spending increases. I mean, there's nothing for state employees. There's nothing for inflation. I mean,
this is minimal increases.
yeah, so
I mean, this is the bare bones on the expenditure side.
Any
And
further questions on this example? Representative Awerkamp.
Thank you, Mr. Chairman. On the Integra Apex, the 11.6, 51.9, 84.9. What's driving those numbers?
the largest is the corporate income tax, because that will, when it's fully implemented for a full year, that's going to be close to 50 million dollars. The other is there's the investment tax credit they get to spread over a period of time. They have a salary credit of 8.5% that they'll get to get credited towards from their withholding. They have some training costs that are included as well.
And sorry if you already said this, and then up 2 rows above that, the income tax adjustments. What are those again?
That's mainly there's a couple things, but the main one is the Social Security. They have it's stepping from the 75 to 100 million.
$100,000, I think. On the Social Security piece, 75 to 100,000.
Yes. What did I say? Millions? Oops.
See no further questions. Let's continue.
Okay. So now basically everything is going to be based off of what we have here. So we'll just have a few adjustments that we make going forward for the rest of these. So you won't have to listen to the thing over and over and over again. So if we go to the blue sheet, okay, the blue sheet is exactly like the yellow sheet with one exception. This revenue line shows a mild recession. So you had asked about what would happen if we were to have a recession. This is a very, very simplistic look at what could happen. So we looked at the recession that we had in the early 2000s, and we just compared the 4 major revenue sources: individual income tax, corporate income tax, sales, retail sales, and compensating use. and we just looked at the year-over-year change. So if the year-over-year change went up, we just kept it as it normally was. But if there was a reduction in year-over-year, then we reduced that line, individual income tax, by whatever it dropped, corporate by what it dropped, sales and compensating use as well. So when we looked at those reductions, the recession didn't hit very hard in the current year, so we left it alone. But the out year, the first time that hit, we show those reductions. So we're thinking that this recession would hit in later part of fiscal year 24. So 25, we reduced individual income tax, and that reduction was about 7.5% from that previous recession. Corporate dropped about 55%. Sales was pretty close to zero, so there was no real change. Compensating use dropped almost 1%. 26, those same tax sources, individual dropped an additional 4.3%. Corporate didn't change. Sales tax dropped 2.9%, and compensating use dropped 3.4%. And for 27, there was a bump, and that bump in individual income after the recession was over, it went up 8.6%. Corporate went up 60%. Sales dropped 2.2 or went up 2.2, and compensating use went up 14%. We did not make any adjustments for any tax laws that happened in those early 2000s. So this is just straight across. So those are the revenue adjustments we made in that consensus line with that mild recession. So if we have everything the same and we show the mild recession, I do want to point out that most of the time, if there is a recession, the federal government will put in some additional federal funds to free up some state general funds. That doesn't include, those are not included in those expenditure lines. So this only shows what the SGF impact was to revenue sources. And it didn't really show much as the expenditures. We didn't touch the expenditures. So when we look at those revenues, we're moving from 10.2 billion in revenue in 27 to 9 billion in 27 with the recession. So it was about, a $1.2 billion reduction in revenue. So if we move through the same process, our ending balance in 27 of 2.6 billion in our previous profile in the yellow sheet drops to a negative 712 million. So it had a large impact on the revenue side. And a lot of this is also around the beginning balances. While the revenue went down $2 billion, our ending balances, that beginning balance, also dropped $2 billion. So that's why it shows a really big impact, because we're spending all of the money we had saved up, money from our savings account. We're spending all of it, and we're bringing in less money, and our expenditures aren't really being adjusted very much. So once again, this is kind of a worst case scenario. But that's something we tend to do, is look at worst case, and we don't try and figure out other impacts that may be happening with different situations.
And I don't want to oversimplify this, but this scenario basically assumes a recession, but then a slight recovery coming back in 2027.
Correct.
Okay. And it also looks like we don't touch the budget stabilization fund in 2027. We're still showing the 1.5 billion. Okay.
So Yeah, we have the 1.5. We wouldn't have to cut anything because there is that $1.5 billion. But um, for this example, it's easier to show the reduction that would have to be made as a negative number. And you'll see all that because we have some other profiles that look at what would happen if we have different scenarios. And all of those leave that budget stabilization fund the same as it started out.
Any questions on this? Representative Corbett?
Chairman, this may not be on this, but it kind of might be. We kind of heard this morning in one of our meetings on the outgoing years, what kind of effect the Apex payments might be and how it might affect the budget. Do you have anything you could share on that for the next 4 or 5 years?
Yeah, I mean, we have the numbers that we included in our revenue. I mean, those are included in these projections.
Do you see a problem that we may get in trouble and may get in financial trouble trying to support that before we get a turnaround?
It depends on how revenue comes in. I mean, if revenue comes in well, it shouldn't be a problem. If it starts to slow down anytime we have additional expenditures or revenue reductions, it has an impact just on the Integra, and it's not as large as the Panasonic. You can see that was an $85 million reduction in 27. So yeah, it would be it's a substantial reduction.
Representative Bergkamp?
Thank you, Mr. Chairman. Thanks for being here today, JG. I guess on the recession forecast, do you think it's being optimistic to push back to 25? Do you think it's more realistic that it could be this next fiscal year with as aggressive as the Fed has been with raising rates and with the banking situation, et cetera?
Maybe. I mean, but what we have here is having that the recession does hit in fiscal year 24 towards the end of it. But it just didn't have an impact on receipts because a lot of the receipts for income taxes like from the previous year. So it will start to show up in those out years.
Yeah, I agree with that. Where it could. I was just maybe thinking it'd be flatter 23 to 24. And then second question, how much more have you built in like the sensitivity to the sales tax with our reductions in the tax law the last couple of years? So like if our tax base is different, is that affected like in future forecasts for?
I mean, we've looked at the impact the impact that we think that the sales tax reduction would have. But we did not grow sales tax because sales tax was reduced. Because if we're reducing our sales tax collections, theoretically, people have more money that they can spend. We just looked at what the impact on the reduction of that sales tax would be. So there's no other implications included in here other than what the fiscal note is for those reductions.
Okay. Yeah, I was just thinking in my mind that a 5% reduction 3 years ago and sales tax would look different than a 5% reduction next year just because we've changed our base. So thank you.
I mean, I believe the numbers we have here were from the Department of Revenue, and they did step those up in their fiscal note when they were looking through those out years.
Seeing no further questions, let's continue.
Okay. So then we go to the pink sheet. We're still in recession mode. But instead of using the governor's tax plan, we just said, let's just put in a general tax reduction. So instead of using the sales and income tax from the governor, this is just saying we'll put in $700 million in every year, 24, 25, 26, and 27. Everything else remains the same. We have the same recession numbers included in here. The one change that you will see is in the Integra line. We do move the corporate income tax up into the $700 million reduction. So we didn't want to count that twice. So that's the number going forward. That's the difference between those two integral lines. So if you look at a $700 million tax reduction, we would become, as far as ending balances go, negative in 26, and we would have to use 1.2 billion of the 1.5 billion in that rainy day fund. And then in 27, we would be 1.6 billion dollars short, and we would only have about 300 million dollars left to use. So we would have to make some type of adjustments. So $700 million impact with a mild recession is pretty hard.
Representative Sawyer?
Yeah, I just want to emphasize that. Okay, so normally, like when you go 26, 27, normally you would carry the ending balance up to the top. But since we can't have a negative starting balance by law.
Right.
We have to cut 1.1 billion or take it from the budget stabilization fund. So that's why that budget stabilization fund is only going to be 300 million in 27 when we still have to come up with 1.6 billion in cuts.
Correct. We would have the 300 million that would reduce that ending balance to a negative 1.3 billion. So that's what you would have to find. And if you did nothing, if you waited until the very end and we had the recession and you did the 700 and you did not adjust revenue or you did not adjust expenditures, that's what it would look like.
All these cases don't really have, I mean, I think it's unrealistic to think we're not going to spend more money on higher ed or some pay raises or something. Aren't in here.
I mean, that's right. I mean, there would be adjustments all the way through here, but what we were just trying to show is something to think about as we go forward, so that when you make those decisions on what to do with higher ed or what to do with social services or what to do with taxes, you have a general idea of what that impact is going to be. And you'll, like I said, this is not a prediction on what would happen, because everybody knows we would be making adjustments. Probably if we had a recession, we'd start making adjustments in 25. So 26 and 27 would look totally different. But like I said, this is kind of a planning document for things to think about, so that you can look and go, oh yeah, we're going to be $1.6 billion short. We'll need to start adjusting stuff now.
Any further questions? Okay, please continue.
Okay. The same thing on the green sheet, except for instead of a $700 million general tax reduction, we would have a $500 million tax reduction. So instead of showing that negative 1.6, we would be showing a negative 1.4, and we would only use $600 million of the 1.5, leaving about 900 million that could backfill that, having about a $500 million hole. But once again, totally unrealistic for this to actually happen. More of a planning document on things to think about. Lots of numbers.
Representative Camp looks like he's wanting to ask a question, but I don't know if he's.
Either that or I've given him a headache.
Okay, seeing no questions on this one, please continue.
Okay. So we're kind of tired about talking about recessions. So now we're going to go back to where we were originally, saying no recession. So once again, we're going back to the yellow sheet for revenue, but we are changing the taxes, the governor's taxes, from her proposal to that same $700 million tax reduction over those same period of time. So looking at that without a recession, once again, moving forward, we would still have an ending balance of about $500 million, about a 5%, a little over 5.5% ending balance. But when you go down to that bottom line, we're spending $430 million more a year than we're bringing in. So, I mean, that would be concerning, but moving forward, this would have a much prettier picture than if we were in any type of a recession.
Representative Francis.
And again, it's a somewhat optimistic scenario, is it not? Because I haven't seen a governor or an appropriations committee yet that didn't spend $1 or $2 more if we weren't in a financial crisis. Or have I seen a tax committee that didn't want to do a tax exemption unless we were in a financial crisis?
Correct. Once again, a planning document, things to think about when you're going forward. We know, how much of a tax cut do you think you would like to do in 2026? What do we think expenditures are going to be in 2026? So that's why I say this isn't a prediction. This isn't what we think is going to happen. This is just looking at bare minimum revenue or expenditure increases, and then revenue based on those trends tamped down a little bit going forward.
Representative Bergkamp.
Thank you, Mr. Chairman. Did the 2020 revenue number, did that include federal dollars, or that's just general receipts, right? So like income tax, sales tax, etc.
That's the only thing that's included in this document. We do get a lot of other federal funds. The total budget's around $22 billion, and we're talking about 10.
So would it be fair to say maybe it's been since 2013, like 12, 13, since we've kind of had like a big decrease in, revenue from whether it's our general fund or, because I guess I consider 2020 kind of an anomaly with all the federal funds that came in. So it seems like it's been 10 years more or less since we've kind of had a true downturn as a state. Does that seem right?
I mean, we had that downturn in 2009.
Yeah, the 8-9 financial crisis.
Yeah, that really hit 9, 10, and 11.
So I guess just basis natural history. I mean, cycles seem to be indicating that we should be due at some point for another. I mean, it just all signs pointed that it's tough to beat history, I would say. So.
Yeah, and like I like to say, economists have predicted 12 of the last 5 recessions.
It's better than my record.
Right, but we did tamp down some of the. Hope nobody's a economist. Sorry, Eddie. But yeah, we did tamp it down, thinking that we're not going to be able to have those increases as we have, and at some point in time, yeah, we are going to have a recession, and that's kind of why the chairman wanted to put something in there on what would happen if we did have a recession. What would something like that look like if we had something like we had in 2000? So I mean, it's just stuff to think about when we look at those numbers and the impact that it would have with and without that recession.
Yeah. Thank you. I'm just glad there's no depression sheet in here. So thank you.
This is all quite depressing. If there's no further questions, please continue, JG.
And then for the last time you have to hear me talk about this, hopefully, on the purple sheet, we have what would happen with no recession. We had the recession earlier. With no recession, and a $500 million general tax adjustments, the ending balance would move to about $1.4 billion. It would be a 13% ending balance. Statutorily, we're supposed to have a 7.5%. So it would have a 1.3, getting close to $1.4 billion ending balance. And our expenditures would be about $230 million more than what we're bringing in, which is fairly close to anything we would be able to really guess.
Committee, any questions on the final sheet? You did make one reference that I wanted to go back to. If we are looking at a package deal, part of that package was, and we heard this yesterday in House Bill 2457, part of that was a increase in the residential exemption on homes for property tax on the 20 mills. It's my understanding that the way I read that money, that expense, that tax cut really didn't come out of SGF. So we would need to reflect that additionally in an increase. If we're not going to cut the school funding, we would have to offset that reduction by an appropriation.
Right. So if you have a $40 million 20 that would affect the 20 mil by $40 million, then below the line, it wouldn't show as a revenue reduction. It would show as an increase in expenditures because school finance isn't getting that $4 million. And the way school finance works is you figure up all the money you're bringing in and how much you need, and the state general fund fills that balance. So if we're bringing in 20 mils less by 40 million, then we would have to put that in a state general fund money.
Okay. Any further questions, committee? Representative Helgerson.
A life example. You said the purple one was the
purple one is the governor's stuff, adjusting Apex, Integra, and Medicaid expansion, taking out.
Medicaid expansion.
No, it's taken out of all of these.
Taken out. No LAVTR because we haven't done it before, and those things there.
Correct.
You haven't added in the increases that the state general fund, that the appropriation committee has already done.
Correct.
Which somewhere around, with school finance, 125, 150 million. You know, I think that's what we're up over the governor.
I thought this morning they said we were down 164, but I don't think it took into account the education.
They hadn't taken
spending
into account the education. When we started the day,
yeah, it was
the
down
governor's,
164.
the chairman said we were below the governor, and then the appropriation committee acted. And now I think when you add that and the others, and special ed, I'm ballparking at 140, 150 million.
Special ed is included in here. The governor recommended that. So those expenditures
It's already in here.
are included in here
Okay.
for 24 and all of the out years.
So with those kind of enhancements, this would be a good chart to use as we're going through when we decide how much for discussions on the House floor as for spending and or reductions, even though we can't use charts at the mic.
I mean, it's something for people to think about.
You could make this available so we could hand them out to everybody on the floor.
Yeah.
Any further comments or questions? Seeing none, JG, thank you for giving us Budget 101. There's a lot of moving parts here, and I do appreciate your efforts, and then Eddie as well, in kind of trying to draft some scenarios looking into the future, what could happen. I'm not sure that we've ever done this in tax before, so I just wanted to provide a little bit perspective. I may have regretted that choice, but but I really do appreciate your efforts and your time today. Thank you. Okay, committee, if we need to take a coffee break, well, everybody's good. Okay. We'll move on to our next item of business. That's a hearing on House Bill 2465, and I would turn to the reviser for an overview, please.
Thank you, Mr. Chairman. House Bill 2465 would clarify the determination of Kansas of taxable income of an electing pass-through entity and provide that for this pass-through entity, tax credits of the entity would apply to entity owners under the SALT Parity Act. Under the bill, The SALT Parity Act would provide that the tax is calculated based on the sum of each resident and non-resident pass-through entity owner's pro rata or distributive share of the electing pass-through entity income attributable to in the state, and each resident electing pass-through entity owner's pro rata or distributive share of the electing pass-through entity's income not attributable to the state. The bill would also provide that tax credits attributable to the activities of the electing pass-through entity shall be passed through to and claimed by the electing pass-through entity owner. Under the bill, these provisions would be applicable to tax year starting January 1 of 2022 and thereafter, so it would have some retroactive effect. And with that, I'd be happy to stand for any questions.
Thank you, Adam. Committee, are there any questions? Seeing none, thank you for that. I would turn to the Department of Revenue to review the fiscal note, but also maybe talk about the movement behind this bill. We kind of consider this kind of a technical cleanup. If you wouldn't mind explaining a little bit about the way this bill came about and what we're seeking to accomplish.
Mr. Chairman and members of the committee, Kathleen Smith with the Department of Revenue. As far as the fiscal estimate with regards to this bill, House Bill 2465 would have no fiscal effect on the state general fund receipts. With regards to how this came about, we have been working with the Kansas Society of CPAs, and based upon the bill that was passed last session, which again allows pass-through entities to pay tax at the pass-through entity level rather than passing the income down. And this was all due to the SALT limitation that was imposed at the federal level. So what we did, or what Kansas did, is we passed this legislation this last year, which would allow those pass-through entities to take full advantage of the deduction at the federal level and would pay the taxes through the pass-through entity rather than passing it down to the individual shareholders or partners. We have been working with the Society of CPAs, and based upon the way the legislation was passed last session, there are different ways that we can interpret the legislation. The Department of Revenue interpreted it one way, and the Kansas Society of CPAs interpreted it another way. And I think that we can read it both ways, but I think it's more clear if we read it based upon how the Society of CPAs has come forward. And I think our conferee will be able to speak a little bit more towards that. With the tax credits, if we want those to pass down to the individuals, we specifically need the legislation to provide for that, because right now it is saying that it needs to stay at the entity level. So I think what I would consider this as a technical cleanup for the SALT Parity Act.
Thank you for that, Kathleen. I appreciate that explanation. Committee, are there any questions? See none. Thank you. At this time, we'll open up our proponent section testimony and welcome Sean Sullivan via WebEx.
Okay, good afternoon. Hope you can hear me okay. Thank you, Chairman and committee members, for the opportunity to provide information on House Bill 2465 applicable to clarifications to the SALT Parity Act. I'm here speaking on behalf of the Kansas Society of CPAs. We're a professional association representing more than 2,000 certified public accountants in Kansas, and we want to offer the following perspectives of our member CPAs. So, as Kathleen just said, some background: Legislature passed the SALT Parity Act last year. This legislation was in response to the Tax Cuts and Jobs Act of 2017 at the federal level, which provided for a $10,000 limit on state and local tax deductions for federal itemized deduction purposes for individuals. So under the SALT Parity Act, a partnership or S corporation can elect to be taxed at the entity level, starting with the entity's 2022 tax year. Then the partnership or S Corp is then allowed a full unlimited state tax deduction in computing the entity's federal taxable income. So as Kathleen said, what we're trying to clarify is that during 2023 tax filing season, which we're in the middle of right now for the 22 tax returns, the Kansas CPAs and accountants and the Department of Revenue offer different interpretations. One, how to calculate the Kansas tax liability for Kansas resident owners versus non-resident owners. And two, how to administer the income tax credit that the electing pass-through owner receives. So House Bill 2465, the solution there would be to provide that one, the changes break up a run-on sentence, which is where some of the different interpretations arose, and insert clauses to more clearly explain how to calculate the taxable income for the electing pass-through entity. You know, the intent of the SALT Parity Act was for the electing pass-through entity to pay state income taxes on its resident owner's income, not apportioned to Kansas. That's because the resident owner will include 100% of their share of the entity's income in their Kansas taxable base at the individual or fiduciary filing level. In other words, apportionment is ignored for the resident owners. They report all of their income to Kansas. Then the second clarification is in regards to helping to properly administer the application of the income tax credit that the electing pass-through entity owner receives to avoid double taxation and to retain the benefit of the tax incentives at the individual or fiduciary filing level. The electing pass-through entity owner receives an income tax credit equal to the tax imposed before credits. And then the revised language clarifies that the intended result is that the owner should not be taxed twice on the same income and that state tax incentives provide their intended benefit. So we believe that this legislation is drafted and does that. So that concludes my comments. I'm more than happy to answer any questions.
Thank you for your testimony. Committee, any questions? Seeing none. Thank you again for your testimony.
Thank you.
I show no further opponents, proponents, or neutral testimony. Is there anyone else wishing to appear on behalf of House Bill 2465? Seeing none, we will close the hearing on House Bill 2465. Committee, I would like at this time to take up what we had on our agenda for yesterday, Senate Bill 8, and I would look to the reviser for a brief overview on that bill, please.
Thank you, Mr. Chairman. Senate Bill 8 would provide that a person would only be required to file an initial statement listing tangible personal property with the county appraiser, and no subsequent annual statement would be required to be filed with the county appraiser regarding such property unless there's a change to report the change in status of the property. Additional penalties for filing, failure to file in certain statements are lowered. And lastly, an appraiser shall extend a reasonable amount of time to file a statement if such request is made.
Committee, any questions on the content of the bill? Seeing none, we are now open for discussion or amendments on Senate Bill 8. Representative Corbett.
This will just be an amendment kind of on starting on the year 24, just eliminate all personal property tax. And Eddie's got a handout or an explanation. That'll cut down on a lot of the mailings coming back. And Chairman, remember this, the money you buy it with is taxed. What you buy is taxed. Why do we have to keep paying on something forever? Just a thought.
Very good. Is that an amendment there? Does the reviser have that to pass it out? Or are you just, that's conceptual amendment?
That's something I think.
I have a little bit of information for the committee. Is probably the in tax year 2021, which of course fiscal year purposes by and large 2022, the total personal property tax that would be captured by this totaled $160.3 million statewide, all taxing entities. So that's the state and the locals. Of that amount, about 155 million of it was the tax, and then about 5 million of that was the penalty tax that is addressed kind of by the underlying contents of Senate Bill 8. Also, of that 163 million amount, about almost 60 million of that was mineral leaseholds, and about 65 million of that was commercial and industrial machinery and equipment. Everything else in that category was $40 million.
Go ahead.
The revisor just reminded me to clarify that this, based upon my conversation with the representative yesterday in advance of this possibility as an amendment, is that this captures Class 2 of Article 11, Section 1 of the Constitution, which does not include motor vehicles. So the motor vehicle tax would continue to exist under this proposed amendment.
Okay.
And that would be open for another amendment if they wanted to add that, Chairman.
I just want a clarification. The 100, is it 160 or 160.3? I don't know if I heard that correctly.
It was 160.3. After that, I kind of switched into rounded numbers.
Okay. And that's the aggregate amount. Do we have what the state impact would be and what the local impact would be separate?
I'll see if I can find that while we are talking through things.
Are there questions? First of all, do we have a second? Representative Helgerson with a second discussion. Representative Francis.
And I'm assuming 40 million is like every modular home and mobile home in the state. So they would be tax advantage to regular single family dwellings.
That is a portion of that $40 million, the manufactured homes that are taxed under Class 2. Yeah.
Any further discussion or questions on the amendment? No pressure. I didn't know. Representative Sawyer is going to filibuster for a second here.
A little bit. Yeah. Well, I just said, a big change like this would probably ought to be done after there's public hearings and we find out exactly how this affects, particularly local governments, because again, they're the ones going to be affected by this the most, by this loss of revenue. So I think this is the kind of thing we should do an amendment like this without having any kind of, at least public input or anything. So I'm definitely going to oppose the amendment.
Eddie.
So I'm going to kind of talk in very generalized terms here, but the counties, and this is for all property taxes, and so it's kind of assuming that the same fraction applies to personal property as does everything else. The counties basically make up between 28 and 29%. The cities make up between 16 and 17%. School districts are actually a little bit bigger than the counties. By the time you roll it all in, they are between 39 and 40%, and then everything else is the other. I mean, those three total make up. It looks like that adds to about 83%, and everything else, the state, townships, every special district makes up the other 17% or so.
Okay, thanks for that work, Eddie. Is there any further discussion? Representative Corbett.
Chairman, over the years when we were taxed 50% for literally nothing, there was no screaming or anything from any of the other government agencies. And, it seems like every time we try to cut a tax up here for the people who are working every day, we always have to backfill and say, well, what about? I mean, very seldom do you get a chance in about 10 minutes to make a difference to a lot of people in the state. Or you can just kick the can and make sure the schools, cities, counties, and anybody else that's got a bucket to put money in can be filled. This just gives the people in Kansas a chance to finally get clean of one tax for a little and move on. But that's just a comment.
If there's no further discussion, Representative Kessler.
Thank you, Mr. Chair. With the
With the carry the amendment, speaking to the mic and kind of just rehash exactly what this is again. We couldn't quite hear you very well, so we're all kind of lost.
Do you want to try that again? Yeah, they couldn't hear. You weren't speaking into the mic.
So did you hear anything that Eddie was telling you? You what? Yeah. So was that a yes? No. So Eddie, do you want to try hit him again?
I think they're just wanting a general understanding
Basically,
of what
what
it
this
does.
is, as we've heard when we first heard this bill, and it's a good start on cutting the penalties and all that stuff. But where I'm going with this is when you buy your personal property, you're buying it with tax dollars. When you buy your personal property, you're paying sales tax on it again. I mean, why should you keep paying on a piece of property year after year after year after year till it either breaks or it can't be used? I mean, I don't see the point in it. That's just my story.
I might, if, and the revisor can correct me here, this is a conceptual amendment. We don't have language, but essentially, Representative, we're getting rid of personal property tax. Is that the easiest way to say that? Okay. Representative Francis.
But just, and Eddie might want to correct me if I'm right, even though it's called personal property tax, 60 million of it is mineral rights. 65 million of it is business and equipment that's being taxed that they probably didn't pay sales tax when they purchased the equipment. And only 40 million of it is actual personal property. Is that the way I heard you explain it?
It is correct that about 65 million of this is commercial and industrial machinery and equipment, and about 60 million is mineral leasehold property. Under the law, those are personal property, the same as the other items that you kind of mentioned. So, in terms of those split out of it, that is the distribution.
Any further discussion? Seeing none, Representative Corbett, you may close and move your amendment.
Chairman, I close and move my amendment.
Committee, you've heard the motion by Representative Corbett to amend. Those in favor, please say aye.
Aye.
Opposed, no? No. Noes appear to have it. The noes do have it. Motion fails. We are back on the bill, and thank you, Representative. I do have an amendment that was proposed by the Department of Revenue for clarification on this. When basically the date starts, and I'll have Mr. Siebers distribute that. They're describing this, what the amendment does.
Thank you, Mr. Chairman. On the amendments on the first page, line 20, it kind of strikes that on and after January 1, 2024, after, and then inserts if. I think there was confusion created with that date as to what year it would apply to. So to clear up the confusion, kind of that language was removed, and just essentially going forward, if they filed an initial statement starting essentially if they filed an initial statement already, that should be good going forward.
Yeah, under the bill as it was drafted, it seemed like they would still have to file one last rendition. This just makes it so where they can use the most current one unless they have not filed one at first. But Representative Helgerson for a second. Okay. Is there discussion on the amendment? Seeing none, I will renew my motion or make my motion to amend. Those in favor, please say aye. Aye. Opposed, no. Motion carries. Further discussion or amendments on Senate Bill 8? I did want to bring to the body's attention, we had another bill. It was House Bill 2411 that dealt with penalties on withholdings. Representative Wagner had brought the bill to our attention. It's similar to this bill. At your discretion. I didn't know if you felt like this would be a comparable bill to bundle together. I don't know if the reviser has an overview of that, but it'd be my preference that we could put these two bills together unless there's objection. I did not have this on the agenda, so I do want to respect your time. If there was amendments that were prepared for that, or if we need to do anything. Okay. I might turn to the reviser then to just give us an overview on what 2411 was, please.
Thank you, Mr. Chairman. House Bill 2411 would change the penalties for employers that fail to timely remit withholding taxes. Currently, the penalty is 15% of the amount of underpayment. The bill would change the penalty to be the graduated amount of 2%. If the amount is remitted within 1 to 5 days, 5% if remitted within 6 to 15 days, 10% if remitted after 15 days, and 15% if the amount of underpayment is remitted after 15 days and the department has issued a notice to the person regarding the underpayment, but the amount of the underpayment was not remitted within 10 days of the issuance of the notice.
And I know that sounded complicated, but if I remembered from testimony correctly, that kind of mirrored or matched the federal.
Yes, that is correct. It pretty much models exactly from the federal wording.
Okay. With that, I would make a motion to amend. Is there a second? Representative Helgerson with a second. Is there further discussion? Seeing none, those in favor of the amendment, please say aye. Aye. Opposed, no. Motion carries. And we're back on the bill. Any further discussion? Seeing none, I would entertain a motion for action on we're on Senate Bill 8. Forgot for a second. Representative Helgerson.
Pass the bill out favorably as amended.
Okay. And a second from Representative Epley. Those in favor, please say aye. Aye. Those opposed, no. Motion carries. Body, I did want to take a brief moment. We're not done yet. Last week, we had Senate Bill 248. It was the food sales tax full exemption considered by the committee. We had it on the agenda to work. I made some comments about that, the bill hearing before we worked the bill. And I never want to give the impression that I'm trying to control what the committee does. And I just want to make sure that we all have an opportunity. If we wish to vote on that bill and do something, I would entertain a motion. In fact, I think I'll go ahead and make a motion to pass Senate Bill 248 without recommendation, just to get it out of committee. If it's your desire to do so, I just wanted to make that opportunity because as I discussed that bill when we were getting ready to work it, I felt like I made some negative comments and that might have influenced the action on the bill. So I will make that motion and see if there's a second. Second by Representative Corbett. And is there any discussion? Representative Helgerson.
Yeah, is this the bill we're supposed to vote no on?
Representative Clayton, did you? Okay. Is there further discussion on the bill? Seeing none, I will close or make the motion to, I guess I've already done that. I'll renew my motion. All in favor, please say aye. Aye. Opposed, no. No. The noes appear to have it. Division was called, but I think it was in jest. Okay, the noes do have it, and the motion fails. Committee, we have one final meeting. I just want to spend a brief moment to explain. We do have Senate Bill 169. It's my intention to put the contents on the agenda for tomorrow. It's my intention to put the contents of House Bill 2457 into that as a Senate bill. It expedites the process. That was the Senate flat tax bill. 2457 is kind of our package that we were talking about yesterday that we heard. Just want to make sure everybody had an understanding of what the process was for tomorrow. And if there's any questions, I would be happy to entertain those. If not, we are adjourned. Thank you.